Welcome to GRE. I'm your host, Keith Weinhold. I'm talking about some reasons not to invest in real estate today and why you still buy for cash flow, why higher mortgage rates correlate with higher housing prices and lower supply, which might be the opposite of what you thought, then Ken McElroy and I on how inflation affects you as both a consumer and real estate investor today on Get Rich Education. A lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both. Jacksonville, Florida, with 27% lower home prices than the national median and 1% higher rents, their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and appreciation for tomorrow. They often have available inventory in Jacksonville. Start at cashflowandgrowth.com. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Schenectady, New York to New York, New York, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Let's talk about some reasons not to buy real estate, specifically rental property. I've really got three big reasons here as to why you might want to avoid being involved in rental property completely. First of all, is that if you're going to need your down payment money back in, say, 3 years or less, then you probably don't want to invest in real estate. Now, of course, this depends on market appreciation and some other things, but due to real estate's illiquidity and transaction costs, count on your money to be tied up for at least 3 years, something like that. Now, a second big reason to avoid buying income property is if you're buying it because you have these feelings of a speculative mania, especially at these accelerated appreciation rates like we're seeing lately. If you're buying just because you think that real estate is going to go up in value, I don't think that's reason enough. Many believe that it will keep appreciating, though. Recently, John Burns Real Estate Consulting moved up their appreciation expectations just for this year. They had expected 8 to 9% appreciation for this year previously. They've more recently moved it up to 12% expected property appreciation just this year alone. So with that in mind, do we then abandon our sound principles and buy at negative cash flow because we're just so sure and so confident and so euphoric that real estate is going to go up in value, or all the other ways that we're paid in addition to appreciation are just going to keep us afloat no matter what? Do we just abandon principles? No, we do not. There are more and more people out there saying that they think housing prices are going to be permanently higher. I'm seeing that word being introduced here more and more often. I'm not so sure. No one really knows. Now, you can do as you will, but I am an advocate of still buying for cash flow. This might come off as conservative to you, but that is how you do control the mortgage in case of a downturn. Now, how low of a return do I accept? Because you know what? The property that you buy this year is probably going to have a better ratio of rent income to purchase price than it will next year. If prices continue to increase in value like this, rents have trouble to keep up proportionally. How low of a return do I accept? Would I buy a property that has a negative cash flow of, say, $200 a month because I'm just so confident about real estate's appreciation that that whole thing just doesn't matter anymore? No, I wouldn't. So if it's positive, even $100, even $50 per month per unit, I like that. I'm still better off having this in my portfolio than most anything else. And I've always stuck by this. Monthly rent income must meet or exceed monthly projected expenses, or I'm not a buyer myself. And, really, that's one thing that I like about podcasting. It's because everything that I've said is on the record. And I've been saying that on this show since the beginning in 2014. So don't get into more real estate if you're becoming overextended or over leveraged. And what does that mean? That means that's when you've lost the ability to service your monthly debt and your property operating costs. That's over leverage. And be mindful that there is a safeguard against you becoming over leveraged, because when you get a loan, your lender helps ensure that your DTI is not too high, your debt to income ratio, and they make sure that you have certain reserves based on your UPB, your unpaid principal balance. So you can still get into trouble and over leverage, but your lender is at least a check on that. They are a hedge against you getting into that condition. So the first reason not to invest in real estate is if you want all your money back in, say, under 3 years. The second one is buying on speculation without cash flow. And a third reason not to invest directly in real estate is if you want to be completely 100% uninvolved at all times, all year, year after year. Well, even with a property manager, that's just not quite realistic. Gosh, just the other day, I got a little email from my property manager about something minor, saying that a tenant wanted to have their sliding glass double doors unstuck, like these doors that open up to their patio that didn't glide well. And the manager wrote that this is a good tenant. They stayed in this single family rental of mine for over 2 years now, and the tenant even tried to fix the door themselves. The manager wanted to reply for me, though, asking if it was okay to dispatch a service person to fix it, which would be a small expense to me. That was an easy answer for me to reply to. I said, yes, get that done. And I also politely stated that I do not need to be informed of such small matters in the future, but it still took a minute of my time. And though the property management company won't inform me of such small stuff again for a while, well, that person at the management company that's reached out might be replaced in 3 years, and then maybe in 3 years I'll get asked a little question like that again. So this is mostly passive income, but it does take a little of your involvement from time to time. So if you want to be completely uninvolved, then I don't think direct ownership of real estate is for you. You might even like some of this occasional involvement to know what's going on. Now that I've tried to scare you off from real estate a little bit with the reasons why you might not like it, with all that said, I don't know of one better singular investment today. A generationally proven asset where you're paid up to 5 ways at the same time, such that a total ROI of anything less than 20 to 25% is disappointing, yet with low risk. And with all that being said, housing is still undervalued today. Yeah, housing is still undervalued, and I've discussed why on some shows recently. Investment real estate is still the best thing going today with the best risk-adjusted return. With stocks today, well, the last time that stocks were valued this highly, that was in the late 1990s dot-com bubble. We know how that ended. And how does that make you feel about more stock exposure? And that, in a way, doesn't even sound frothy when you compare it to some other things going on, like the price run-up in something like Dogecoin, a cryptocurrency based on a dog meme that now has a market cap that's higher than Ford and eBay. Yes, Dogecoin is worth more than those companies. So, yeah, real estate is pretty fundamental, pretty necessary, and it has the best risk-adjusted return going today. And few people really understand something like Dogecoin, but you know what? Anyone understands that someone will pay you money to live in a home that you own. So coming out of this recession here, we're getting more confidence that that's the direction that we're going in because we're seeing higher employment and we're seeing more business openings. Well, is this going to diminish these extensions of mortgage forbearance and eviction moratoriums like we've been seeing? We'll see how long they last. But one thing is apparent. One important takeaway has emerged here. President Joe Biden, he wants to keep people in their homes. He does not want people kicked out of their homes and on the street under his watch. He does not want that happening while he is president. And Biden, and even the CDC, they appear to have more tools for doing that than you might have thought previously. So throughout this presidency, that is one constant driver of policy to keep in mind. For better or for worse, Biden does not want people to lose their homes. Now, though mortgage interest rates are still super low, they have come up off their bottom. Most economists and analysts don't think that mortgage rates will spike substantially higher in either the short term or the medium term. But you know what? When interest rates do go up, that typically means that property prices go up as well. Did you think that I was going to say that when interest rates go up, that property prices need to go down? Well, one might think so on the surface. But yep, higher rates usually mean higher prices. And that's counterintuitive to a lot of people. They might say, and these are some real world numbers here. Let's just take a $500K loan. At a 3% interest rate, that's a payment of $2,120 per month, okay? $2,120. If that rate rises 1%, now your payment is $2,400, $280 a month higher. An increase in payment with the higher rate, $2,120 versus $2,400. And a lot of people stop right there and they say, that's it. That's all I need to know to see that it hurts affordability. And prices have got to head down. They've just got to. Well, that's what a lot of people think, but actually just the opposite happens. In fact, if you look at the last 6 times that mortgage rates rose, during those last 6 time periods, housing prices, in fact, rose every single time. All 6 of those times that interest rates rose. And those periods were 1994, 1996, the 1998 to 2000 period, the 2005 to 2006 period, 2013, and again in the 2017 to 2018 period. So those are all 6 of those times when we had rising interest rates. And during each one of those 6 periods, home prices rose. They didn't fall. And you know what? It's happening for the 7th time this year lately. Rates have come up off their bottom and home prices keep rising. So this could seem counterintuitive to you. Why does this happen then? Well, remember what it means when interest rates rise in an economy. Rising rates, that is a tool that's used to cool inflationary pressures from an economy that's heating up. Rising rates, that means an economy is heating up. More people are being employed typically. More businesses are profitable. There's a greater velocity of money. Wages and salaries are often rising. Well, all these things give consumers both confidence in the economy and a higher and steady income. And when people are working and they feel stable and positive about their job, well, what do those people do with a now stable job? Well, they figure it's time to settle down and do what? Buy a home. So the higher mortgage payment due to higher rates is trumped by the higher salary. And it's outpaced proportionally by the higher confidence in the economy. More people with more stable jobs means more home buying. And that is why the last 6 times that rates rose, home prices rose as well. Now, with that understanding, understand too that higher mortgage rates correlates with lower housing supply. So why would higher rates mean lower supply? Well, let me just turn this over to you and ask you, put yourself in this situation. If you're paying a 3% mortgage rate in your home right now, and rates soon spike up to 5%, let me ask, how willing would you be to move? Well, not very, because just to buy an equivalent replacement home, you would have to then make a higher payment for ostensibly the same quality of life. That's a trade that you're not very likely to make. So therefore, you and others are reluctant to put your home on the market. And that reluctance means then that there are fewer homes on the market. That is why higher mortgage rates correlates with lower supply. So lower supply in turn puts even more, upward pressure on prices. So note that it is remarkable then that last year, despite a lowering of mortgage rates, home prices still rose. So to summarize your lessons here thus far on this show, higher mortgage rates correlate with higher housing prices, higher mortgage rates correlate with lower housing supply, and understand that economies and markets are pretty complex. They don't respond to just one variable, and a lot of times it's not the variable that you expected. So with that in mind, let's talk more about how inflation affects you as a real estate investor or even as an everyday consumer. Now, first, on the consumer level, so we're talking about you doing things like buying car gasoline or buying a sack of potatoes at Trader Joe's or buying a swing set or trampoline for your kids and putting it in the backyard. Well, everyone pays a different rate of inflation. Everybody does. Changes in the car gasoline price, that affects the long-distance consumer a lot more than the stay-at-home computer programmer. Inflation in the price of beef does not affect the vegetarian, and this unevenness is true across society, across states, across cultures, across nations. Now, understand that as a real estate investor, inflation might matter to you 4 times as much as it does a layperson that works a day job and invests through their 401k. And this is because you're often getting a loan for real estate. You might put down just $250K in down payment or equity into a property and borrow the rest so that your total asset value is $1 million. Well, now your entire $1 million worth of property is subject to inflationary forces. That whole million is, not just the $250K. So that's why this stuff really matters. And that's why I talk about inflation more than some other people. Of course, I've explained to you before how leveraged real estate investors win the inflation triple crown, which is the term I coined when you win with asset price inflation, debt debasement, and cash flow enhancement. And I mentioned 2 of these 3 in the video with Ken McElroy that I'll soon play the audio from for you here. Inflation is insidious. Insidious means gradual and sneaky, but with harmful effects. It's only when you look at a longer timeline that you can see how significant inflation really has become and how it affects you every day. For instance, right now, I'm looking at a menu from McDonald's restaurant from 1974. Here we go. This will really give you an idea of the effect of this inflationary creep over time. A Big Mac sandwich in 1974 cost 65 cents. A quarter pounder cheeseburger cost 70 cents. We're talking about the main portion of a meal here for substantially less than $1. And I would have thought that the Big Mac would cost more than the quarter pounder too, but moving on. In 1974 at McDonald's, a filet-o-fish sandwich cost 48 cents. A hamburger, just a plain old thin burger, but still a little sandwich, that cost 28 cents. Gosh, 28 cents. What can you get for 28 cents today? One gumball to chew on for a minute, maybe? A large order of fries was 46 cents. A coffee or a hot chocolate, they each cost 15 cents. Sheesh, imagine looking up on the overhead display menu where you order at McDonald's and seeing any item listed for 15 cents. A triple ripple ice cream cone, whatever that is, was 20 cents. That almost doesn't even sound real. Again, this was 1974 at McDonald's. Well, do you know how much a Big Mac burger costs today? Let's get some comparison here. Let's measure the change. And of course, this isn't a perfect inflation measure. We're not talking about the size or the quality of the ingredients of a Big Mac and how that's changed. But again, back in 1974, I told you a Big Mac cost 65 cents. Today, that Big Mac costs fully $4. So with it costing $4 today, that is more than a 6-fold price increase over 47 years here. So that right there, that is the diminished purchasing power of your dollar created by inflation. and it doesn't seem insidious anymore when we look back and compare things over a few decades that way. So let's fast forward to some more contemporary measures of inflation without getting into the government-reported CPI and core PCE and all that. What about wage price inflation? 2 months ago, Costco CEO Craig Jelinek said his company is bumping up their starting pay to $16 an hour. That is $1 more than the $15 you start at Target, or the $15 you start at Best Buy, or the $15 you start at Amazon. As this economy gets rolling again, expect lots of new hires, driving up prices in an economy, or at least leaving the potential for that to happen. You can look elsewhere, like the latest stimulus bill. Washington, D.C., in fact, will have spent more than $5 trillion on emergency aid for Americans over this past year, or a little over a year here. So, for reference, Obama's stimulus package following the Great Recession was less than $1 trillion. It was $840 billion. I just told you it was $5 trillion in just the last year, or a little over a year. So that's also a six-fold increase. In fact, more than 40% of all of the money ever printed was printed just last year. Gosh, that is just astounding to think about. So they are some numbers behind this higher inflation potential. Not a certainty, but potential. So when we talk about inflation, think through what this means to you more philosophically for a moment here. Let's pull back. Let's take physics. From the discipline of physics, you know that power is work divided by time. Theft is the opposite of work. Then money is a claim on your work over time, and you sure don't create value by theft. Theft only takes the value of others' work, and that's what inflation is. So you've got to store the value of your work free from inflation, which, as I said, is theft. And this really is a core value proposition of what real estate represents when you tie up long-term fixed interest rate debt on a cash-flowing property. And as we know, inflation transfers wealth from lenders to borrowers. Sometimes it might make sense to be on the lending side, but you generally want to be a borrower, especially when you're in your wealth building phase. And what we get to do is continue to short that dollar as we tie up that real estate debt. Well, with Rich Dad Real Estate Advisor Ken McElroy and I discussing inflation and other real estate topics for about a 12-minute segment ahead, this was an in-person, yes, not a virtual, but an in-person tutorial that Ken and I gave in his Scottsdale, Arizona offices. And though I was talking to my audience in this video, you'll soon hear the audio from this. I was talking to Ken's audience too, so you might hear a couple of things that I've discussed before because I was explaining some things for his audience's benefit. Ken and I next on inflation benefiting real estate investors. And you can see the full video from this presentation and a lot of other great stuff on our Get Rich Education YouTube channel. I want you to check out our YouTube channel because I've put more effort into that this year than ever before. And you know, the person that we hired earlier this year to be our video manager at GRE, his name is Matthew. He was a GRE podcast listener. And about the time that we brought him on here, he basically told us that the podcast is like the best he's ever heard anywhere. But he was then disappointed to find out that our YouTube channel didn't really meet the same standard. Appreciate the honesty there, Matthew. So he has come in and really rejuvenated our YouTube channel to meet the same high standards that we have for the show here with aesthetically pleasing production and graphics and more. So I encourage you to check out our Get Rich Education YouTube channel. We've still got fewer than 10,000 subscribers there, so it's not nearly as popular as the podcast here. And on YouTube, a lot of that material is different from the podcast here. That channel and this show are usually two different things. So if you'd like to learn more from me that way, most of my videos there are 10 to 20 minutes long. Great free wealth building learning. Check out Get Rich Education YouTube. Ken and I on inflation and real estate investing straight ahead. The people that our listeners can't stop talking about are Ridge Lending Group and MLS 42056. They provided you with more loans than anyone. It's where I got my last few loans, and they finance single-family income property up to fourplexes. They're the #1 lender for both beginners and veterans. Start your pre-qualification, chat with President Chaley Ridge personally, and you'll end up with your custom plan for expanding your cash flowing portfolio. Start at ridgelendinggroup.com. You know, starting in real estate seems hard for some. Even experienced investors can find it difficult to achieve the success that they had hoped for. What if there was one small change everyone could make that would solve these challenges? Allie Boone offers a book that really no one else has. It's an easy-to-understand glimpse into the real estate investing industry and your mindset. It's life lessons on hacking your mind before you hack your wallet. Her book to grab on Amazon is called Not Your How-To Guide to Real Estate Investing.
This is Rich Dad Advisor Tom Wheelwright. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
It's Keith Weinhold here. I'm in Scottsdale, Arizona at the MC Company's headquarters with Ken McElroy.
Hey guys, how are you?
You probably already know about Ken. He is the Rich Dad Advisor for real estate. He's the founder of MC Companies, where they do a lot of things, but you really thought of as the apartment syndicator. And Ken is also a prolific author. In fact, the last book, did you even know this, Ken, that I read every single page of, cover to cover, was your book, Return to Orchard Canyon.
Oh, thank you.
Yeah. Well, with that in mind, talk to our audience about what you think they need to know today as a real estate investor.
So here's what we're seeing. So we have a couple thousand investors in our various projects. We have about $1 billion worth of multifamily, office, self-storage. So 250 employees. And so we've been raising capital and putting people, high net worth people into deals. And here's what I think the biggest issue most of them have. So our investors are coming to us and they're saying, listen, I have $1 million, I have $2 million. I'm going back and forth. I'm looking at retiring. My problem is that when I stop, I don't have any income because I have a job. And so they're frustrated. So they're like, well, maybe I should keep working. And if I don't keep working, where can I stick that $1 million, let's say? And is it in the right spots? And does it produce any passive income? Because what they're trying to do is replace their income. So if they stop and their paycheck stops coming in and they're sitting in, let's say, a low yielding investment, they're not able to live and they're going to start eroding, whatever capital that they had in the bank or in investment with an investment advisor or whatever. So that's the biggest thing I'm seeing right now, Keith, is with my own investors, they're looking for things that cash flow.
Yeah, because a lot of people are yield starved. A few years ago, you could invest in a savings account and maybe at least get a yield that keeps up with inflation. But even in the non-brick and mortar online first ones, you can't do that now. So that pushes more money into assets, running up prices, making yield more difficult a lot of times.
A lot more. And that's precisely why we haven't been able to buy at the volume that we were buying. So we have the exact same model, same investors, same acquisition people, same management companies, same markets, and we're getting pushed out of deals because they're getting priced really high because of low debt, and people are coming out of assets, let's say in areas, and they're pushing up and creating bubbles in other areas. And so some of those markets that we're in right now, I think that we're in the bubbles, but we have to back away or walk away because the returns are maybe half of what we were getting even 10 years ago. And so we're now looking at new markets. But I think the biggest issue is, my demographic and a lot of my friends that are, let's say in their 50s, they're concerned because they don't have cash. Even when I was in my 40s, the little bit of money I had, I wanted it to work for me. And I knew at some point I wanted to have that money working for me so I didn't have to work. Right? I want to work, but I didn't want to have to work because I didn't want to erode that savings account. And what happened was now we have inflation. And so we're starting to see inflation is going to start eroding savings. And that's why we put this up here, is that I think before, Keith, certainly when I was growing up, and my father used to say, they would pay off their house, they would save all this money in the bank, and that was the right thing to do then. And that's what I started to do because I learned from him. And then I was realizing that my savings account, especially in the 70s, I was like, what's happening here? A dollar just from 72 to 84 went down to 40 cents, I think it was, just from a purchasing power. It's still a dollar in the bank, but it just bought less. And so I was like, okay, I'm going to have to figure this out if I'm going to stay ahead. How am I going to stay ahead of inflation? And so my savings account, thankfully I was a young kid trying to figure this out. So I'm like, I have to invest and figure out and invest in something that rides inflation and something that works with me as opposed to against me.
Right. We're looking for that inflation-adjusted return, that real return, not the nominal return. Nominal means what our return is in name only. If we have a 10% rate of return and 4% inflation, you have a 6% real return and a 10% nominal return. You talked about inflation earlier. The CPI, the consumer price index that the government measures, is pretty low right now, and the Fed's had trouble meeting their 2% target. We can talk all day about how that number is manipulated. But really, when we talk about inflation, the pure definition of inflation is more dollars circulating in an economy. That's what inflation is in this purest sense. But what we're interested in talking about is what affects you, the diminished purchasing power of the dollar. Your Chipotle burrito cost $8 last year, $9 this year. Price inflation that affects you at the consumer level and at the asset price level. That's really the inflation that we're concerned with. And some people think that we have inflationary pressures building, even though they're relatively low right now. You can actually harness that and benefit from inflation as a real estate investor, but your experience with inflation has really just been it's diminished the purchasing power of your dollar. So you're probably thinking of inflation as a bad thing, but as real estate investors, we can leverage that into a good thing.
Yeah, inflation doesn't care. That's the cool part. I mean, it doesn't care if you're saving money or you're in debt. It just doesn't care. It's money. So it does what it does, and you just need to know which side do you want to be on. So if you're going to save a bunch of money and we're heading into high inflation, that money that you saved is going to buy you less. If you're in debt, then that money is you're going to pay off that debt. You're going to pay it off with cheaper dollars. So you just have to decide.
So let's imagine that you have a real estate portfolio, might be your primary residence plus your rentals, and just say your entire debt on that portfolio is $1 million. Inflation helps erode and debase that debt for you. So say we have 10% inflation over, it might be more than 1 year, but just 10% inflation over a period of time. Now, after that period of time, you don't owe the bank $1 million real dollars. You only owe them back $900K in inflation-adjusted dollars. You just got an inflation-profiting tailwind because you tied up long-term fixed interest rate debt. And you know what's interesting, Ken? A lot of people, when I tell them about that, they say to me, well, what do you mean, Keith? What about the interest payments on that debt? No. In a cash-flowing rental, your tenant pays the entire interest payment for you, plus a principal payment for you, plus hopefully a little on top of that called cash flow. So your debt is therefore outsourced to the tenant. So just like inflation debases your lump of savings, similarly, it debases your entire debt amount. That is a good thing.
Right. And this is what so one of the things that I've been predicting is I believe that the reason the Federal Reserve lifted the 2% target and said it might be a little more is if you go back and look, you're going to see in the 70s and 80s, inflation was all over the map. It's just been 2%. In a lot of people's lifetimes. But if you go way back, like when I was a kid, it was a lot higher. And so what I think that they're going to do is now that they're spending all this money through this financial stimulus and we got trillions and trillions of dollars going out and potentially even UBI or universal basic income, all of that stuff potentially, then the one thing that will lower that is inflation. So if inflation is unleashed, then that debt, the government debt or your debt, it's the same. It's going to be paid off in cheaper dollars later. So they could deflate their own debt with inflation.
It's about really, I think you're talking about aligning your interests as an investor with what the government's interests are. The government has $27 trillion in national debt, so they should have an interest themselves in debasing the dollar. It makes them easier to pay back their debts with these diluted dollars, just like it would you and yours. You don't have to like what the Fed's doing. You don't have to agree with what they're doing. But if you align your interests with what they're doing, you can be a profiteer.
Yeah, Tom Wheelwright, one of my good friends that talks a lot about tax. I said, the tax code is so confusing. He goes, it's actually not. He goes, all you got to do is see what policies are being passed and then follow the line. He goes, the government basically tells you where they want the tax dollars to be put. So whether it's housing or whether it's oil and gas or whatever it is, it's the same thing here. The government's going into debt, and what's the best thing is for them to be able to erode their debt with inflation over a period of time. So if you have that same mindset yourself and you go into debt, good debt, not bad debt, then you can do the exact same thing. And you're actually riding this wave exactly just like the government's doing at this very moment.
And good debt still perplexes some people. I can think of a couple cases of good debt. Number one, I sort of touched on that. When your debt is reliably outsourced to a tenant, meaning you have a conservatively bought cash flowing rental, that's good debt. And the other way is when the interest rate that you pay on debt is the same or less than inflation. Before we started chatting here, I brought up the point that now that mortgage interest rates are about the same as the long-term rate of inflation, if you buy a rental, even if it had zero cash flow and it broke even, you still would not lose money over 30 years, even if the property doesn't appreciate and even if it didn't break even, because that's how low interest rates are now. And I like to say, debt is maybe my favorite four-letter word. This is why maybe the word loan is my favorite four-letter word, somewhere in there. So Get in love with debt, the right kind of debt. You really can profit from it when you do it right.
So guys, if you lock your loan at say 2.5% and inflation goes up to say 4%, you're in the money. Basically your inflation is it's actually better to inflate this because you're borrowing at 2.5%, right?
Yeah. Well, I talked about how your total debt amount is debased with that $1 million example. It works similarly with your monthly payment. You only have to make the same principal and interest payment over time on a property. Call that $1,000. Well, inflation makes it easier to pay that back. If you have 3% inflation in a year, in inflation-adjusted dollars, you only owe back $970 a month after year one, $940 after year two, and so on. So it really works a few different ways. You have any last thoughts on inflation, debt, or what a real estate investor really needs to know?
I would just encourage people to take a look at inflation rates over the long haul because I think they'd be very surprised. I mean, in the last few years, the last 10 years, they've been kind of hovering really low. But even if you were a saver, you were losing because they were 1.5%, 2%. Your savings rate isn't even close to that. So I would just take a look at that. And then maybe this will all come into perspective for you and you'll be able to see that it looks to me like the government is going to be relaxing the inflation target rate. And so this is a good time to get in fixed rate debt while that happens. And then you can ride with the wave with them.
Oh yeah, it's always great talking with Ken. I feel like I grew up reading his Rich Dad books, and I have certainly learned things from him over the years. You can learn more about Ken at kenmcelroy.com. Let's tie up a good bit of what I've discussed today here on this, I guess, rather well-rounded show about real estate investing and economics. As long as you're all right with real estate's illiquidity, it is difficult to think of a better investment on a risk-adjusted return basis. Sometimes counterintuitively, higher mortgage rates actually correlate with higher prices and lower supply. Everyone pays a different rate of inflation, even you and your own spouse. A reminder from Ken's input there is that inflation can go much higher. It was over 15% in the 1980s. But as we think back to what we learned from Richard Duncan last month here on the podcast, we don't expect high inflation anytime soon. Duncan and I did discuss the caveat, though. Remember that if Biden's infrastructure bill does get implemented, that is something that could elevate inflation for a time. But in short, I do expect more inflation to continue to come like it has been, not deflation, but that rate of inflation should stay low for a while, as much as we might like it to increase because we know how to benefit from it. Hey, if you'd like this conversation to continue after the show here, if you want more, check us out on YouTube. And I don't know how much longer I can do this on YouTube, but lately, if you comment on any of the many new videos there, or even the earlier ones, I will reply to your comment myself, and you'll know when it's me because I write my name after my reply to your comment. And you know, YouTube can be a place where you get some kind of weird comments from people at times, but you know, GRE followers really come up with some of the more intelligent questions that I've seen anywhere. So I hope to see you over there soon. Our YouTube channel is called Get Rich Education. I know you can remember that. We are, I guess, consistently branded. In any case, I'll be back with you right here on the podcast next Monday to help you build your wealth. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.